It is so important to ask questions and look at different options when getting a whole life insurance policy. Where do you think most people have buyer's remorse when they start a whole life insurance policy? It's when they find out it could have been better, but they didn't know what questions to ask when they were working with their agent and setting up the policy. So I met with someone this past weekend who was looking to put about $500,000 into a whole life insurance policy. He's primarily interested in cash value. So a little bit on his situation. He's interested in moving $500,000 into a policy to use it for real estate. He's interested solely in the cash value because it's a safe place he can put his money. It's liquid, meaning he can access it like a line of credit for real estate. And then as long as we, the agent, follow IRS rules, he can use it tax-free. So that's what he's interested in. And he looked at it and said, it's better than what I'm doing right now, meaning just having cash in the bank that he'd like to be able to use for real estate investments. So his specific plan was to move $50,000 per year into a policy for 10 years. That's $500,000. Now, he originally looked to move a lump sum of money into the policy because he's got about $200,000 just sitting in the bank right now. And he was shown an option with a lump sum, but it didn't look that good. He looked at it, it looked okay, but he had some questions on it. So it looked okay because of the setup. So he was interested in MassMutual. He was working with a MassMutual agency, and it looked something like this. So in the first year, there's a deposit of $200,000. And then after that $200,000 deposit, there's the $50K per year that he wanted to pay into the policy. Now the product that he was shown is referred to as a L65, stands for Whole Life 65, meaning that he can pay into it up until he's 65 years old. And up here with MassMutual, you see 10x limit. What that means is if we put in $200,000 in the first year, it can't be more than 10 times our base premium. When you pay money into a policy, it can go toward your base premium or your paid up additions rider. So we have a $20,000 base premium. So aside from the first year, where he paid in $200K, beginning year 2 he pays in $50. If he's paying $50, it means he's got a $20,000 premium and a $30,000 PUA. It's not going to be that efficient. Now I know that can be confusing, so let's look at some numbers. Here we go. So here's an illustration showing exactly what I just described. This is a whole life 65 policy. In the first year, you've got a $200K deposit, then $50K per year through the 10th year. Payments stop at that point in time, although he can keep on adding money if he wants to. Here's the cash value. So he's got about 170 in the first year. If you put in 200 and you have 170, that's about 85% of your payment in first year cash value, which is not bad at all. Starting with a lump sum will do that for you. Now, if we look at it year over year, you'll see that cash value accumulate. What I'm going to do for this example is pull it up on Excel because it'll make it a bit easier just to track the performance and the overall returns. All right, here we go. So here's what we just looked at, but a bit cleaner format in my opinion. There's your base premium, $20,000, PUA of $180, annual outlay is the net out of pocket you're paying every year. Total outlay tracks all of your payments. Then you've got the cash value and death benefit. MassMutual's dividend rate for 2025 is 6.40%, but that is never what you're actually earning on a policy. The annual yield, which can also be called the annual rate of return, displays the net growth rate on your cash value year over year. What is highlighted in yellow, which is policy year 6, is the break-even point. That's the first year. The cash value is equal to your total payments. All of the prior years, he has less than what he paid into the product. That was yelling at him. He didn't like that because if he's going to use the money for real estate, the hard part with this is, well, if I put into this, I got to wait 6 years just to get my money back. That's a huge lost opportunity cost. Now, this design is not bad. It peaks at almost 5.5% when we look at the annual yield that is based on the current dividend interest rate, and things will change over time. But it's not bad, but it could be a lot better. He asked a lot of questions. A little bit on his background. He's in the military, very, very attentive to detail, asks a lot of questions. He actually met with the other agent, or multiple agents, but the other group 5 or 6 times and kept on questioning them until he got what he wanted. So, how can we make it better? Here's what I would do. He wants to stick with Mass Mutual, so we're not going to change the company. There are companies that are more favorable with a one-time lump sum payment, but in his case, he really liked Mass, so we want to stick with Mass. Here's what I would do. Firstly, with the funding, we want to keep that not the same. In the first year, I would put in $100,000. And then in the second year, I would also put in $100,000. Then after that, call it years 3 through 10, I would put in $50K per year. So we can do it this way. Years 3 through 10, there's the 50. So with Mass Mutual, knowing that the limit is 10x the base premium, what you will find is it is way more efficient if you can max fund a policy for the first 2 years instead of just the first year. It's going to beef up that upfront cash value. It's going to get you an earlier break-even point, and you'll see stronger long-term performance too. So now what we're going to have is a policy. You've got a 10K base premium and a 90K PUA for 2 years. And then from the 3rd through 10th year, you've got a 10K base premium and a $40,000 PUA payment. So we're able to consistently carry a lower base premium, shovel more money into PUAs, which gives you more cash value. Let's take a look. So we'll look at the illustration, and then we'll compare the two side by side. There's the whole life 65. Here's the whole life 10 pay. So as we look at this guy, there's your 10K base premium, 10 pay product, funding, 100 years 1 and 2, and then 50 through the 10th year. Cash value, $90,000 in the first year. It's 90% of what you pay in immediately shows up in cash value. Now, let's take a look at the Excel sheet. So here you go. What do you notice? Well, the base premium, instead of 20, is now 10. PUA is 90, annual outlay is 100, but you're max funding it, meaning you are 10xing that base premium for 2 years instead of just 1 year. And then as a result, instead of breaking even at year 6, the break-even point actually falls between year 3 and 4. Year 3, you've paid in $250, you're at $245, and then year 4, you've paid in a total of $300, and you're at $306. So a lot more cash value up front, an earlier break-even point, and when we look at the long-term performance, do you remember what the other one peaked at? It wasn't 5.6%. 10-pay product is more geared for long-term cash accumulation compared to the L65 as well. That's how Mass Mutual designed the product. So let's look at a comparison. On the left, you've got the L65. On the right, you've got the 10-pay. So we can compare the cash value year over year, and to do so, we can just look at this. So this is showing how much more or less you have in cash value with a 10-pay product compared to the whole life 65 product. So what do you notice? Well, in the first year, it's quite significant, $80,000. Why? Well, look at your first year payment on the whole life 65. How much did you pay in? $200,000. How about the 10-pay? You paid in $100,000. So you paid more money into the L65 policy, which is why you have more money in the first year. Now you'll notice the L65 has more through the 10th year. However, what's the difference in the 10th year? Just about $3,000 in favor of the 10-pay. Look at the total outlay columns though. What do you notice? Well, the L65 is $650,000 and the 10-pay is $600,000. So what this is showing is you have $3,000 more in cash value with a 10-pay, but you've paid in $50,000 less. So what we can do is back out the extra payments we've made over time, and this would show the true cash value difference, which is in favor of the 10-pay policy from start to finish. See what I mean? So what I would do to make it better is look at a product that's more favorable for cash value. Being the 10-pay product, I would confirm that he does want to fund for 10 years and not any longer, because that 10-pay product, I can only pay into it for 10 years. And then if he does want to fund with a lump sum, what I would do is spread it out over the first and second year, because that allows me to lower the death benefit, which lowers the costs, lower the base premium, max funded for 2 consecutive years, and it gives me more cash value from start to finish. That's the big reason why. Now, from a compensation standpoint, what I would make with both of these, with the L65, with the design we saw, it's mainly with that 20K base premium, it's going to be more than $17,000. It's going to be closer to 18K actually. Whereas with this guy, it's going to be closer to 6,500 to 7,000, and that's in the first year. And that's based on the commission rates that we would make with our overrides and everything. So much more favorable toward that L65. Commissions do impact performance when you look at it. So last thing we want to hit on is, what did he do? So let's look at the final plan here, shall we? This will be fun. And we didn't just make it better, we made it as good as we possibly could make it. So where we want to start here is with his original plan, 50 for 10 years, but everything maxed out, and then compare it to an alternate scenario, which is similar to what we just looked at. So let's look at the 50 for 10 years first. So what we've got, 50 for 10 years. What do you notice about this? Well, it's a 10-pay policy. Your base premium is $5,000, 10% of the total payment. When's your break-even point? Year 4, just like the last example we saw. So this is showing what he was originally interested in, the $50,000 per year for 10 years, but maxed out from start to finish. So if someone asks for something in terms of, I want to see this, we want to make sure we show them that. And then if there's an alternative that we think is possibly better, then we'll show that side by side. And also make sure that it's suitable just from a funding perspective too. Now, here's an alternative. This shows the same product and him paying the same $500,000 in, but over 5 years instead of 10 years. Now, he's got to have the liquidity and means to be able to do this. In his particular situation, he could do this, but it would cause some stress. He said, I don't know about that. The funds that I have dedicated that I could easily put in right now is about $200,000. That's money sitting in cash. And after that, I could easily continue to put in $50K per year. So while this looks good, it wasn't realistic. Here's what he liked. This is what we looked at earlier with the comparison. And then we also showed this, 100 years 1 and 2, followed by $25,000 per year thereafter. Here's the thing about those 3 alternate options. They are all the exact same policy. You've got the minimum premium of $10,000, and all we're doing is just adding different dollar amounts toward the PUA rider, which with MassMutual, he can easily bounce that up and down as each year passes. So this way, we made it very flexible. So if right now he's got $200K in cash, he moves that into the policy for 2 years. And then by year 3, he says, I've got another 100. Well, if he said, let's go with this one in the middle, doesn't mean he has to pay in 50 in year 3. We would just scale the payment up. That's what most of our clients do. Life happens, sometimes for better, sometimes for worse, and we set the policy up to be as flexible as possible. Minimizing the premium gives you maximum flexibility and also gives you as much cash value as possible. So we made it better simply by reducing the expenses and looking at a product that would give him more cash value with his lump sum that he was starting with. And now he's in a much better position where he can use the policy not just to grow his money safely and faster than how it's growing right now, but he can also use it for real estate. Because when I borrow against the policy, I keep earning dividends and interest on the amount that I borrowed. So let us know if you enjoyed this video. And as always, I hope this helps. Thanks so much.